So here's the uncomfortable truth that most bot traders don't want to admit. Your AI trading system is basically blind when the news hits. And I'm not exaggerating. During the last Fed announcement in 2024, we saw execution gaps of 2 to 5 minutes, where bots literally couldn't respond fast enough. Positions that should have closed out at one price got filled at a completely different level, sometimes triggering margin calls instantly. Welcome to FinTech Bot Focused, where we discuss, dissect, and implement all things automated trading. If you're into AI tools, trading bots, and FinTech innovations, make sure you subscribe. Let me paint a picture. Your bot is trained on thousands of hours of normal market data. It learns patterns, volatility ranges, support and resistance levels. Everything works beautifully in calm conditions. Then the ECB announces a rate decision. Price gaps 300 pips in seconds. Your bot's volatility model says this shouldn't happen, but it does. And by the time your bot catches up, you're already bleeding money. Now here's where it gets really interesting. Institutional quant funds figured this out years ago. They don't just let bots run 24/7 like some retail trader hoping for the best. They deploy defensive strategies. 3 of them, specifically, that we're covering today. Strategy number 1. Economic calendar integration with autopause logic. What this means is you're literally checking the economic calendar programmatically. Your bot knows when major releases are coming. Fed decisions, non-farm payroll, central bank meetings, all of it. Then, 15 minutes before those events, your bot stops trading. And it doesn't restart for another 15 minutes after the announcement. This simple move eliminates 90% of your news-related blow-up risk. You're stepping aside during the chaos, and that's smart money. Strategy 2 is volatility regime switching. This is where you're monitoring indicators like VIX or average true range in real time. When intraday volatility spikes more than 30% above baseline, you're cutting your position size in half automatically. You're not exiting entirely. You're staying in the game, but you're reducing exposure during dangerous conditions. Think of it like lightening your load before crossing a rickety bridge. Same destination, lower risk of falling through. And then there's strategy 3, pre-event position closure. This one's straightforward but requires discipline. You know earnings are coming Tuesday. You close your positions Monday afternoon and lock in whatever profits you've made. You know the Bank of Japan is meeting Thursday. You're flat by Wednesday close. You're sacrificing potential upside to avoid potential catastrophe. That's not pessimism. That's professional risk management. The beauty of these 3 strategies is they work together. Your bot pauses during known events. It shrinks when volatility explodes, and it exits before known catalysts anyway. You're building layers of protection, not betting the farm on perfect execution. So before you go, make sure you join the FinTech Bot Focus newsletter. You'll get updates on new bots and AI features, strategy breakdowns, my honest takes on what's working, early looks at new automated trading tools, and you can reply with video topics you want covered. The link is in the description. Join the community and stay ahead of the automation curve. Disclaimer: this video is for educational purposes only, not financial advice. Trading, especially automated trading, involves risk. Always trade at your own risk and test everything before going live.